Hi, everybody. Welcome to another episode of Breakfast with Brokers. This is episode 4 in the new format with my co-host Tom Worley and Erin Connors, both of Angle & Volkers. And today we have a very special guest. We have worked with Mr. Barrett Ketchian, I think since most of us started our careers. So Barrett Ketchian is here from Loan Depot. He has, well, I'll let you intro yourself, but please tell us a little bit about yourself.
Yeah, thanks so much for having me. Glad to be here. I've been doing mortgages for about 30 years. I have a team that I've built over the years to originate, and then I happen to manage a branch too.
You do?
Yeah, I mean,
I know that.
Yeah, I mean, it's my branch.
It's a big deal.
We have a bunch of people that work for it.
How many times have you been to his office? His name's plastered on the glass. I mean, he's legit.
Yeah,
I know he had titles.
We're lucky enough to have, be number 1 in volume in the state of New Jersey and, number 8 or 9 in the country every year for the past 5 years. So we've got a system that works. And, we try to help our agents best we can. And that's it. Like, our goal is to give the client a good experience, transparency, consistency. And that's, to me, the most important thing you could do in mortgages.
Yeah, agreed.
Yeah. And anything, really.
What's also awesome is like when you go to Barrett's annual holiday party and he finds me somehow when I just walk in the door and he's like, "Psst, you and I over here." And I get the good stuff.
Yeah. I do love wine, so that is a part of my life too. Yes.
What he forgot to mention there is he as well is a tortured Jets fan like the rest of us out there. So
my loyalty and my loyalty can't be questioned. No doubt.
It's true. Very true.
Yeah.
All right. Well, we're going to hop right in because I know you are a busy man, but very generally, what are you seeing right now?
We're seeing obviously, rates have come down. They're probably at their 2-year lows for the most part. We've seen territory like this recently, this isn't like we're not a 0.5% below like the best rates, but we're certainly at a very good territory. So a lot of people are refinancing. So in our world, that's something. For the purchase market, I mean, the suburbs are as busy as ever. We're still seeing multiple bids constantly. There's still a very huge demand for single family homes from all those families that probably are stuck in spaces that are too small. Brooklyn, New York, Jersey City, Hoboken, everybody's moving out and they're skipping the step up condo, like the 1 bedroom that they squeeze in, then they have kids. Normally they would go to a 2. They're skipping that, going right to the burbs. So we're feeling some of that in Hudson County where you may not see as many resales, but I'm also seeing any property that I would consider to be unique or something that really provides a value to go. Your, paper cutter, 2-bedroom, 2-bath box, maybe they'll take a little longer, but anything with any character, brownstones, they're still going crazy, immediately, highest bid. So I think to me, it's the property that's going to dictate it. Price range is going to dictate it because you see some new construction that is struggling because I'm guessing it cost them a ton of money to build it. They were probably not expecting the cost. And so some of the pricing is higher than you would expect, and it's causing some, slow sales.
Yeah, we hit on that the last episode with the new construction stuff, right? How many developers got stuck holding the bag on the way things skyrocketed that they just didn't have built into their pro formas and were not prepared for.
Carrying costs. I mean, the rates obviously that they were carrying the money at, the timing. I'm sure things got delayed with COVID. Then on top of that, you have, costs of construction have gone up drastically.
The mansion tax shifting.
The mansion tax shifting was a massive thing, right?
Yeah.
That's a huge one too. Yeah. That cost them a ton of money. So yeah, I'm sure they're priced into their prices, which is unfortunately slowing down the market there. Yeah. But I think a lot of resales are still going. Anything with anything that has size to it seems like it still flies.
That's why we sold our place. I mean, I think people were shocked that we sold the place that I curated for 10 years, but it was, Pat and I sitting across the table and just being like, this is what everybody wants. We're going to get the max. And that was it. I mean, 100%. I was shocked at the response.
100%. I think finally people that were sitting on their, 3% rates and below are starting to get sick of it because now they've held on as long as they can, hoping for these rates to come down, which is not going to happen. So in some cases they're sacrificing that and just moving to their bigger spaces, just getting it done.
So let me ask you about that, right? As we talk about that lock-in effect. That's something that we've talked about. We've seen a lot of that lock-in effect from those artificially low rates.
Yeah.
Are you seeing people be far more patient now with because they don't know whether or not they want to lock in? Are you seeing things kind of free up with those rates coming down? And do you think that realistically will ever see anything in those low fives or even with a 4 in front of it in the foreseeable future.
Say yes, Barry.
Yeah, no, I think we will. I mean, we're already seeing some of the, like the longer adjustables in like the low fives, 5 3/8, 5 1/4, 5 1/2. So like once people are comfortable with those, and most people are, I think that will precipitate them to sell their place, move on to the bigger and better place that they really need for their family. So at some point, like now you're on year 3, you're going to lose your mind sitting in a freaking 2-bedroom apartment with 2 kids. You can't keep doing it. So like, I think they held on, and now everyone's just sick of it. And I see tons of people coming back into the market, calling us for, hey, you remember me last year? I'm back. This time I think we're going to do it. Can you update our pre-approval? We're seeing a lot of that. So I think if we get to like a 5% fixed rate territory, it probably won't be until next year at best. I would be shocked to see it this year. Okay. I mean, we're still up in the high 5s, like, on a fixed rate. So I think that'll help move along more people to sell. There'll be less people that hold on to their apartments to rent out because they'll be like, all right, time to get this equity out. But yeah, I mean, I think currently there's plenty of people out there that are in the market looking. There's definitely more demand than supply.
And it's funny because that brings up 2 points, right? One of my questions was going to be, with those rates and so many people locked in, are you seeing a lot of people leverage that 3% rate and say, I'm just going to hold on to this and rent it out? Or are more people saying, with affordability and everything else, I can't afford to hold this even though it is a 3, I have to sell it to upgrade and get what I want?
So we have seen that. Here's the counterpoint to that. There's a lot of people. So if you do hold on to it, you can't pull the equity out in most cases, right? Because you're about to, it's about to become an investment. So now you're leaving all this money in this property. And what are you using for the down payment? Now you're using your investments. Well, if you pull out your investments, which have done so well over the last like 5 years, now you're going to pay massive capital gains tax when you could have just sold the property and replenished yourself. It's a tough call, man. It really is.
Literally what we did, why we did what we did. I can't tell you how many people called us and they were just like, are you crazy? Keep it forever. And I'm like, you can't.
Because if you don't pull your money out, like some people just can't afford to have that much money tied up in equity.
Right.
But anyone who can is holding on to it.
Yeah.
I see a lot of people still at the 2.7s and the 2.6s. They're like, yeah, we're going to keep it. But in their cases, like they have more capital and they're able to do it. Sure. They're putting down less on their new house and holding on to the old one. But yeah, capital gains are a factor. I mean, stock market's freaking done ripped in the last 5 years. So a lot of people, and that's a major cost, it's 18 to 20%, a lot of cases.
On that topic, there was this whole big thing about assumable mortgages.
Yeah.
Oh my gosh.
Much ado about nothing.
I was going to say, what's in your opinion, I know I'm not going to hold you to this percentage, but what is the average, what is a percentage of mortgages that are actually assumable?
I mean, FHA loans are assumable and VA loans are assumable. Beyond that, I haven't seen many that are, but but the problem with an FHA loan, okay, so let's say you want to assume somebody's mortgage, they got it 5 years ago for $300,000. You have to make up the rest of the money. Like, where are you getting the rest of it?
Right.
So it's like, unless they have a mortgage amount that you can make up the difference with, it's hard to do. And it's just not an easy thing. If it's VA, you have to be a veteran. We actually had a crazy case where this happened, where a new veteran took over for an old veteran and it worked. And they got a ridiculous rate in Hoboken on a brownstone of all things.
What?
Like a $2 million mortgage. Yeah. And amazingly, it worked out. But it was so painful because I wasn't processing their mortgage. They were just going through our servicing people. They had to look at them and make sure the new people can afford it. And I had no eyes on it. So it was like a mess, but like they kept calling me and we did our best. It did go through and he was able to get, but it's such a rare thing. Like, and they would never be able to do what they were proposing, trying to get us to, it's too hard. Like, Yeah.
Okay. All right. Speaking of them,
Yeah.
The Fed shakeups.
Yeah.
Good, bad thing, your opinion?
So far, good. You know, the market's reacted well to it. I can't imagine the current regime being more conservative than the last one when it comes to dropping rates. So I can't imagine it being a bad thing. And obviously, if, the current regime has their way, the more people they get on board, they want rates to come down. I think in some cases, I understand inflation is there and I do get it, but I think they have to come down. There's an affordability issue right now with like first-time buyers. They cannot get into houses. Somebody making $150,000 should be able to buy a condo for themselves and, start a condo easily, and they can't.
Yep.
A $600,000 condo costs you like $5,000 a month.
Yeah.
For $150,000, that's too much of a payment.
Versus what you can get for renting it.
Yeah,
and that's the point. It's like
that's the issue. So they have to come down to some degree. but they should do it gradually. It shouldn't be an overnight thing. They shouldn't do what they did during COVID, where they artificially lowered rates.
Right.
Because that's why we're in this situation now. The whole reason we're in this situation is they went from so low to so high. So it screwed up the whole ecosystem now because people can't sell because they're too low. And like if it was like, listen, we lived in the 4.5 to 5.5 range for like 15 years.
Oh, I'd give.
And it was totally fine. The market was stable. There wasn't this big supply demand differential. It wasn't a seller's market for the last 5 years. Like it was a pretty balanced market. People lived with those rates. They understood those rates. And I think that's where we need to end up as a country. But it's going to take a little time, I think, for inflation to calm down because we kept things so low for so long.
And that's much higher than all of our pay grades combined.
100%. Yeah, somebody's going to have to do it. Yeah, it's gonna, but I think there are some factors. Unemployment is absolutely becoming a factor.
Yeah.
We're seeing more unemployment, and not just unemployment, employment where like somebody loses their job, they try to get back in, but they can't get in at the same pay.
Okay.
So now they're taking pay cuts to just get back into the workforce, and they can't get the similar jobs. AI is taking out a lot of jobs in the tech industry for sure. So like these things are happening and we're seeing it. Like we're seeing, a lot of people telling us about it. There's a lot more, tech people that are now working contract instead of full time.
Yeah.
And so these are all like things that are going to eventually hit the market that I think will cause rates to come down the line.
So this is a whole other episode that we're in the process of planning for because that involves like a lot of planning. We have a really interesting special guest and I'm interested to get your take on it. But the AI thing, I mean, we've seen this recently where we have a lot of people that have lost their job. I just lost something in the Heights that the guy was like, they gave me the option to move to California or I don't have a job. Yeah. And he was like, my whole family's here. I'm not moving to California. And he lost his job and the whole deal died.
Well, I just read that this past January's unemployment is the worst January since January of 2009. Yep. So that is huge. People are getting nervous about, like, I've had buyers who were like, we're just going to wait and see what's going on with our jobs before we do this. And I mean, how many of people are in that boat? Like I have a very good friend of mine. She's been in the same company for 17 years in the C-suite level and lost her job. Yep. And to your point, can she find that C-suite level job anywhere else, or is she going to have to take a pay cut?
Yeah.
I mean, that's
what's interesting is I think the C-suite is on the chopping block.
Yes, 100%.
We've seen the majority of the people that we've had deals where they were shaky was because they were making $300,000-400,000 a year. And they were like, we don't need to pay you anymore. Yep. We just had an AI bot do like 60% of your business. And it's like, that to me is, I think, probably the one thing that I'm most nervous about is like, our price points are high. And
the problem is certain sectors are doing great still. Like their bonuses are going up every year. They're killing it. And then there's certain sectors though. Finance is still doing pretty good. I think there's some people, like when you look at like the Googles of the world and the Amazons, there's still some people making big money, especially because obviously they have the shares they give out too, the RSUs. And so I think there's some people doing well, but those who get cut are having an impossible time getting back in. And so now, like, and we're seeing it. Like, it's like the stats are one thing, seeing unemployment stats. I'm seeing it now in real life where it's like hitting. I'm like, wow, like you lost your job. Like we call somebody for a refinance and they're like, yeah, I just can't do it yet because I'm in between jobs. And I'm like, oh, shoot. I'm like, this guy was making freaking $350 last year in between jobs. Surprising. Like you would think somebody like that would be able to pop right back. Doesn't seem like it. So
I mean, we had this conversation too. You and I have a couple clients together who basically we would start our search and they'd be like, all right, my max is 1.3. They'd lose a couple bidding wars, the whole thing. And then like, my max is 1.9. And I'm like, whoa, like where did you find $600,000?
Calculating.
And are you seeing more of that? Like,
I mean, people are going above their price range, I think, to get their house and just counting on, refinancing down the line and hoping. But it's like, it's you shouldn't go into it like that. But we hope, like when I do a budget for someone, which to me is critical, like we try to keep it conservative. Like what is a really comfortable number that you can afford? Let's start there. If you have to stretch above it a little bit, fine. But let's start with the number that, you can, super comfortable. And then we'll go over those numbers. That doesn't work. All right. So then we're gonna have to go a little higher and you're gonna have to make sure you get that bonus every year.
So let me ask you this, right? With the people stretching their budgets and everything else, right? We hear a lot of people and, the chatter of, oh my God, are we preparing for another 2008? Our stance is no.
I don't think
From a mortgage perspective,
we don't think so either.
Why are we not looking at another 2008?
Because I think rates are going to come down over time, like whether it's this year, next year. So I think people will be able to refinance, number one, to get a little bit of relief. Despite the unemployment thing, most people are still gainfully employed. People are putting down money. We're not doing no income loans, all these crazy things people were doing back in 2008 that, were lending out 100% of the value of the property on an investment property, silly things like that. There's no negative amortization loans anymore, none of that. So everything is vetted with both income, credit, and assets. Is it impossible for some people to not be able to pay? Of course. But if you look at the foreclosure rates in the country, they're really low still. So therefore people are paying and they would just sell their property. There's more equity right now than any time in the history of the United States. So why would people lose their house and cause that kind of drop? They would just sell it, right? Yeah. Like if you're in trouble. So I think that's helping a lot.
So to really explain it for that first time buyer who's hearing from his uncles, friends, college roommates, best friend, what was the problem with 2008 that caused that type of fallout? And a quick synopsis, obviously we know about it, but a quick synopsis for people that just are getting information from the wrong places.
So basically there was a lot of risky lending going on at that time. And they were lending even like in some cases beyond the values of the homes are at 100%. So when the market itself went down, like where the prices went down, these people had nowhere to go and all their rates started jumping up. And so stuff like that's not happening anymore. All those risky loans are out of the market. And people were just taking more and more and more risk. All these investors that on Wall Street were buying this stuff too. So none of that stuff's happened now for 15 years, 20 years almost. So you're not seeing that. So the odds of that happening again are so low. Plus supply and demand. Like, are you telling me homes in the suburbs are all of a sudden going to go down $200,000 when right now they're literally like fighting each other for homes, offering their pets up for, just to get their offer accepted?
I do get nervous about that.
I don't see it in the suburbs. There's still so much demand over supply that if rates come down a little bit, those prices are going to probably keep going up. And
but also for all of our listeners out there from Hudson County, he doesn't see it in Hudson County either. So take a breath. We'll be okay in Hudson County.
Yeah, Hudson County is the same thing. I mean, like if rates go down, people are going to be able to afford more place, and there'll be there's so much pent up demand, and people are on the sideline just waiting for like that next shoe to drop. But if rates do hit like say 5%, which I think is certainly possible by next year, I think you're going to see a ton of people in the market and buying and keeping the prices where they are.
What the general rule of thumb is like for every percentage point, for every full point that a rate drops, you lose 9% of affordability.
That seems reasonable.
Right?
Yeah.
Gain 9%.
Gain it. Yeah. Yeah, that sounds about right. Yeah, that's reasonable. Figure like, if you go from, 6% to 5%, I mean, that's a pretty sizable difference on a loan, on a $100,000 loan. Yeah, no doubt. So like, you'd gain about 10 to 15% of buying power just with that drop.
For a full point.
Easily.
Wow.
Yeah, even a half a point, you're going to gain a lot. Like that, look at the loan sizes we work in. $1 million loan, half a point is $500 a month.
Now, for somebody trying to do those calculations quickly in their head or running their own numbers, things like that, how can they? What's an easy rule of thumb for money?
$6 for every $1,000 is currently the number. Like
$6 for every $1,000 borrowed is
so
where
you're
going
to borrow. 500,000. 5 times 6, 30, $3,000. That's your payment.
Okay.
That's a good way to give you a nice round number.
Okay.
$1 million is $6,000, like that type of thing. Quick math, that'll give you at least an idea. Then add the taxes, add the HOA. That's the part everybody forgets.
Right.
They go on Zillow, they look at the mortgage, they're like, oh, this is great. And then they forget to add the monthly taxes and the HOA.
Yeah. Or their insurance and everything else.
Insurance isn't too bad. Prices are going up on insurance, but they're not too bad. Yeah, right. But the HOA in some of the areas, and you really have to look at the HOA with all these things going on condos and all the reserve studies and realizing, wow, we have no money and we have all this work to do. The HOA fees are going up.
So I'm going to throw one at you that we did not prepare you for, but you just popped in my head. Now with New Jersey raising the elevation levels by 4 feet.
They did again. I didn't even see it, to be honest.
Yeah.
Oh, fun.
So
I did not see that either.
It's certainly affecting our Monmouth County buyers and sellers. But how does that really translate to your side of things? Like, is it just strictly you have to just get more insurance? Or
I mean, I think some of the flood insurance might be grandfathered in if it was above the elevation at the time they took it. If they're going to actually look at it like now and consider those higher risks, then I mean, flood insurance is going to go through the roof. Even on some of the new construction places that built above the current standards, they're going to go up. I mean, so that would affect flood insurance costs for single family owners, condo fees for condo owners because the condo flood insurance is going to go up.
Yep. And
so, it's definitely, I mean, everything's in effect. Insurance as a whole has gone up already by a significant amount.
Yeah.
It's ridiculous. So flood insurance especially is, I have clients right now. Granted, part of the reason that they're selling is obviously to get closer to family, everything else, the same reasons a lot of people sell. But one of their big pushing points was, taxes in the town went up and their flood insurance just continues to go up. And the flood insurance, they have to have flood insurance for their garage area, and the insurance company's going, you're going to have stuff in there that we have to cover. You have to insure the garage because their place was raised. They bought it already pre-raised, but they enclosed the garage. Yeah, they enclosed the raised area to make it a garage, and now the insurance company looks at that as has to be insured, and it hammered them.
I just take a hammer to the garage and keep it open.
Just keep it open. Just keep it. Make it a carport.
Make it a carport. Yeah, you probably save a ton of money.
Since you do so many loans, I mean, how many loans do you do a year? Do you have that number?
Last year we did a little over 700, 800. My team, not our branch. Yeah.
What's the craziest deal you've ever done, or what was a deal you thought was going to fall apart and you saved? Like,
I mean, we have so many that, like, I hate to say, like, it was hard to find one. Like, I was thinking about this yesterday because you said that we might run into this one. We've had so many crazy ones. Like, we've had cases where, like, we had a condo get declined in the middle of the freaking process by Fannie Mae. Like, wasn't declined when we started, and it got declined in the middle. And we literally had to get enough documentation to, like, get them to change their mind, which is like, it's like trying to change a 4-year-old's mind. It's impossible. And so, like, we got that done. We have cases where, we had a loan that we had to do in order to buy the next house. And, you'd have something come up where it was like, oh, wait, you didn't tell me this happened since last time. And so you have so many last minute things that come up that we have to work around. No matter how great your questioning is up front, there could always be a weird surprise. Yeah. So there's too many to count, to be honest. Like, most people around here are well qualified, easy stuff. Although with condos, nothing's easy. I would say, like, we've had our crazy cases. We usually question enough up front, though, to make sure that we discover as much as we can. And my goal, like, with our whole team is, hey, just ask the questions day one so that, like, we don't run into this. Like, I'm a high anxiety person to start with. The last thing I need in my life is this stuff to come up a week before the freaking closing. Like, let's at least address it day one. Don't assume it's going to work. Don't throw darts and hope it sticks. Like, that's the one thing I've instilled in not only my team, but everybody in my branch. Like, just check. It's easy. Just one extra step. Ask our underwriting managers. We have access to them, and make sure that what you're looking at works. So
with that, with as many loans as you write, what is the most common issue from the buyer perspective that you run into where you go, how do we continue to have these buyers make this same mistake over and over? No matter how much we educate them, they continue to do this, and this is always an issue.
They won't tell you something because they are trying to, like, hide it. Like, we've had people who left their jobs and didn't tell us until, like, literally we did the verbal verification at the end of the process. And we're like, you left your job? They're like, yeah, but I had a new one. So I'm like, yeah, but I have to vet it, man. Like, I can't just, like, assume it. So, like, now it's like 4 days to go before the closing. We're vetting a new job. We've had people not tell us about property they own, which didn't show up on the credit report, but they own it, which is a debt. And they're like, yeah, but it's free and clear. I'm like, yeah, I know it's free and clear, but it's a tax on it. There's insurance on it. That is a debt, not an asset. Right. So, like, that one's a big one. How about child support? Like, that is appearing nowhere on their pay stub, but they have child support from a marriage and they did the application as unmarried, so we can't ask anything further. Stuff like that comes up.
We had the one where the guy didn't tell us he was married.
Yeah, we have one. Right? We've had one.
We sit down at the table, and the guy's like, literally, our attorney gets the thing, and he's like, hold on a second. There's another person on this deed. And he's like, oh, yeah, that's my wife.
Yeah.
Wait, you're married? He's like, oh, yeah, well, separated. I'm like, so you're not even divorced? And they're like, no. And it's like, everyone go home. Everyone go home.
Yeah, like, I try to ask the question, like, say, is there anything, like, I wouldn't see on the credit report that, like, we need to deal with? Like, and I'll say, like, examples would be, and just get it out of the way so that any other properties, whatever, so we don't.
So how can you now, when that happens, tell us a little bit about, like, the creativity that because I think the biggest thing for people to realize is our jobs here at this table is to work for you to get you across the finish line to accomplish your real estate goals.
Yeah,
we can't do that when you're actively fighting against us or hiding things from us. So we work for you. Tell us everything so that we could help you help yourself. Yeah. So in terms of being creative and making sure that you still can get that finish for people, what are some things that you've done?
Yeah, so, like, if it's a child support situation, you just have to find the debt ratio room to do it. Hopefully you're not super tight at the end of the day. Like, we try not to have our loans be at, like, the last, percentage of the debt ratio that's allowed. So hopefully we have the room. You can end up using a bonus or overtime or something else that maybe you weren't using originally to qualify. If you need to, you might have to get a cosigner. That there's really not that many. You can pay off debt. Like, if there's, so let's say you come up with child support that puts you over the ratios, You have a car payment. We could say, look, let's put down a little less money on the property. Let's pay off the car because that's going to be much better for our debt. And, that might work. We can pay off, something else here, something like that. But that's all there is. I mean, you just hope when that comes up that you're not in a situation where there's no room to do anything.
Right.
But, our mind goes into overdrive right then and there, and we try to come up with something.
Yeah. So stop hiding stuff from us.
Yeah.
If you want to buy a home, tell us, because we'll help you, but you can't hide things from us.
Yeah. Our goal is, like, if we know everything, we'll know how to put that together within the rules. If you know the rules well enough, you can use the rules to your advantage and say, okay, we could do this here, we could do this here. But if you don't know something, it comes out of left field. Those are always hard. Yeah. Not too many, but like when they do happen, they are stressful as hell.
I mean, one of the things that I think people think is you have to put 25% down.
No, absolutely not. Yeah, no. You could put down 5% and get the same loan pretty much with 25%, with the exception of mortgage insurance. That's the only difference. And PMI's gotten cheap. You have good credit right now. Like, I was just looking at a loan where, like, it was like $500,000-$600,000. The PMI was like $100.
Oh, wow.
For 5% down.
Wow.
So, it's almost silly to put more money down.
Yeah.
Why would you?
In ways, because, like, you look at the capital gains, tax you're going to pay on the stocks you're liquidating, versus, just putting down 5% and just making a higher payment. You're better off making the higher payment a lot of times.
And that's based on the PMI is based on your credit score.
It is
debt to income ratio and everything else.
You look at the overall factors. Debt to income ratio under 45% is usually what you want. Credit score higher the better. Multiple borrowers help PMI. So if you have two borrowers instead of one, that's a risk factor that helps you. And so, all those things come into play. And there's like 6 or 7 PMI companies. We kind of shop all of them, find the cheapest one, because that one's truly like a commodity. So whoever insures it for cheapest. So
with the question about we shop the PMI, everything else, and I know that we're going off topic here on what we had lined up, but tell us a little bit about the difference between going with somebody like you versus when I get a call and they say, all my banking is with Chase and all my banking is with Wells Fargo. So why go with a Loan Depot versus a big bank?
I mean, to me, like, having your banking with someone, it's not like that's going to get you anywhere. You're still going to have to provide the same documentation. They go through the same process. I just don't think they have as skilled of people. Like, if you look at, the top 100 people in the industry right now, like they rank us every year, I'd say probably 90% are lenders, maybe 10% are banks. Why? Because the banks just can't get, like, highly skilled. Like, they'll never be able to recruit somebody like me because they're too limited. Their box is too small. And
What box? Explain to us box.
Their overall, like, parameters for loans are too small.
Okay.
They can't think outside of it ever. They have too harsh a guidelines. They have guidelines that are even beyond what Fannie Mae puts out, even though you're doing a Fannie Mae loan. So they'll have overlays. And so things like that I can't live with. I have to be able to have somebody that can speak to all the time.
So the bank. So I go to a bank and I say, Chase Bank, and I'm getting a loan there. They're fitting me into that one product that they offer.
Pretty much.
And you're able to say, I've got that product, but I've also got all these products over here.
And just being able to speak to them in more of like an advisor way, like, hey, listen, like, tell me what you're doing in this condo. Is this like a 5-year condo? Probably be a 5 to 7 year condo. All right, well, we should be looking at this loan because it's going to be even cheaper for you.
Mm-hmm.
They just don't do that. It's here's your number, here's what it is. And so, and they don't have anything cheaper. Like, most of the time, unless you have a ton of money at one of these banks, or you're giving them a ton of money and you're doing a big jumbo loan, they probably have the same, if not worse, rates on most loans as lenders.
I think, and that I've been dealing with a lot of buyers, and they've said the same exact thing. Well, I get all my business through Chase and whatever, so it's just easier. And I always say, just please call around and give your number, give another number, and I'm like, ask him the questions, and 99% of the time they switch. Because I feel like they don't understand. I mean, it is sort of it's sort of like what we do, a handhold process, where you're thinking outside the box, you're fixing questions. And I always tell them too, you want me to be working with somebody that I know, that I can pick up on the phone and handle the problems before they get there, where I don't know an 800 number, so it helps the whole process. I think it's a little smoother to get to the finish line when you're working with somebody that you're a team.
I think the one thing people, especially in this market, underestimate, it's not a commodity. Like, you're not just buying a stock. Like, it's a process.
Right.
And in a condo market, like, you better know someone you better be working with someone that understands how the condo process works. Because right now there's more gray area and workarounds that we have to do, and things that we have to chase after, and solutions we have to come up with midway than ever in my 30 years.
See episode 5.
Yeah. Fannie Mae has become very difficult with some of their criteria. They are, ever since the Florida building collapsed, and that was a major tragedy. They have gone overboard, though. The pendulum has swung to a level where it's like you're asking lenders to be engineers, and like, we don't know what's safe, what's not safe, and if it gets to them, they're just turning it down right off the bat, not even a thought. Otherwise, we have to make that business decision, and it's hard. If you work with somebody that doesn't know condos on one of these deals, it's like going to a foot surgeon when you have a heart problem. Like you're going to the wrong person.
Yeah.
Like you're just because they have mortgages doesn't mean they know what they're doing here. And so I think they underestimate that more than anything. They just shop on price. Like, oh, let me have a loan estimate, shop this loan, like 8 loan estimates. Like, to be honest with you, I won't even do that anymore. I'm like, this isn't how I work. Just do your thing. Good luck. I think you want an online lender, and I hope you close.
Yeah.
I had a horror story last year dealing with something like that. We were selling their place and they were buying a new construction, and we had a lender that had everything lined up. Yep, you're good. You don't need to sell that to buy this. We're going to do this, this, and this. They got creative with everything, with all the solutions. Chase found out that they were going for a loan. Oh, you're a private client. We've got this, this, and this. Hey, Tom, we're going to switch over to Chase.
Yep.
No problem. They went through Chase. Get a call 2.5 weeks before closing. Oh, well, you guys still own that property over there. You can't buy this at this price with owning that property. You have to sell that. And the buyer went, oh, I went into this and told you everything that was going on. My agent told you everything that was going on with that property. No, we can't do it. They scrambled, went back to the original lender, and thank God the original lender was able to scramble. And I think we went over the closing timeline by about a week tops.
Well, because I think what people don't realize is like there's a line of buyers that are literally waiting and approved. So if you can't close, the seller's literally like, no worries. And they got 5 other people 7% higher. So it's like, people think like, oh, if it's okay, we'll just work it out and we'll get it. No, you don't have the time. Like you don't close, and there are 5 people waiting to take your spot.
In a lot of cases, they have higher offers than yours that may have come in even after the final invest, and they are looking to get out of your deal. And if you missed your commitment date, you just gave them the green light to get out. You actually gave them a legal way to get out of your deal because you missed the commitment or didn't provide a good enough commitment that had way too many conditions. Like people just don't get that. It's not a commodity. And they'll do this over 1/8% or a few $100s. And you're like, you're going to have this loan for probably a year. You literally are talking about $600 when you're spending 1.2 on the property. And you're going to even like, it's kind of like, I joke with it, but it's like, instead of, taking an Uber directly to your event, it's taking a bus, then a train, then walking 6 blocks, and then riding a bike to it. Like you'll get there both ways, but there's an easy way, might cost you a few dollars, and there's that way. I think a lot of times, like take the easy way. It'll make your life easier. And this isn't just a Barrett thing. This is any lender, I think, that cares about their job and like truly like does this for a living and is like has pride in their work will be better than most like online or bank loan officers.
All right, so lightning round because we have to let you go. We're going to ask you a series of questions. You have to respond as quickly as possible. Don't think. Favorite food?
Steak.
Good one. Favorite steakhouse?
Dino and Harry's.
All right. Favorite wine?
Favorite wine? I'll say Chambertin Clos de Bez. I just had a bottle from Louis Jadot from 2005. Best bottle I've ever had.
Wow. Okay. Favorite ice cream flavor?
I usually go with coffee.
Best place to travel to?
Turks and Caicos.
I was going to ask you what your favorite drink was, but I think we know. Favorite color?
Blue. I'm a blue guy.
Favorite musical artist?
Bon Jovi, no question.
Wow. Fighting words at this table.
Even though he's a New England Patriot fan. Which
I know. What's up with that?
To announce the Patriots.
I don't know how that happened. It hurt me deeply. Go ahead.
Jersey card revoked on that announcement.
If you could have any car in the world, what would you be driving?
I'm not a car guy at all. So to be honest, I would drive the same car I have now, which is a X535 BMW.
Nice. I love it.
I have no issue with it.
I have nothing else. Anybody have any questions?
No.
I've got one more question for you.
I do too. After you.
You go. You go.
Who is your favorite? We have a Hallmark movie relationship here. Who is your? We may have discussed this, but who is your favorite current female and male lead? Who has the best chemistry that you're seeing out there? Hard hitting questions.
Oh gosh.
The answer to this.
I mean,
we've been talking about this while you guys were late. We had a full on conversation. Our Lacey Chabert.
Yeah, not for me. Yeah, the problem I have is I don't remember any of their names. I can look at their faces and be like,
yeah,
that guy's all right,
yeah,
and that girl's all right. I like them together. But yeah, unfortunately, Candace Cameron Bure is still my favorite, even though she's no longer part of Hallmark, and she does make an amazing wine, which with her husband, which is awesome.
And he's a hockey player, so that's again okay. All right, you're off.
My last question, and we covered a piece of this already. Who are our Jets taking it to, or who do you want our Jets to take it to? I don't follow college enough to the point where like I'll watch highlights and that'll be my
So I thought Zach Wilson was good. Just watching his highlights, they look pretty good. So I guess, Bain maybe is the best guy from Miami. I'm not against the safety from Ohio State either, Downs. I think he could be a good player, and there's a lot of great safeties that lead a defense. So who knows?
Fair enough. So defense, we're going defense.
I think you got to go defense. There's not any offensive players that.
I think that's fair enough.
All right.
Cool.
This was awesome. Thank you, Barry, for the years of service and taking care of our clients the way you do, and of course, sneaking us off to those good wine corners of your party, and always up for a great conversation.
There'll always be good wine.
Always be good wine, right? We don't know where the rates will be, but there'll always be good wine.
Why drink bad wine?
Exactly. It's awesome. Thank you guys so much for being here. On behalf of Tom Worley and Erin Connors, listen up.